My name is Aniyia Williams, and I am a director on the Responsible Technology team at Omidyar Network. And Omidyar Network is a social change venture that's working to bend the arc of the digital revolution towards shared power, shared prosperity, and possibility. I lead a body of work at the firm that's focused on building alternative tech ecosystems, which includes alternative products and services and business models and funding structures that put the interests of people at the center. And I've long been a champion of expanding the capital stack in the industry for investing in startups. So I very much believe that we need alternatives to venture capital. So I'm really excited to be talking about financial products that we can learn from. But first, let me introduce our wonderful speakers here. We have Lizette Peña, Wendy Turman, and Stephanie Gripne. Lizette is the treasurer and serves on the board and investment committee of Kachuwa Impact Fund. She also serves as a fractional CFO for impact companies. Excuse me while I juggle this here. Wendy is president at Market Impact Capital, which provides fractional CFO and blended investment strategies. She is also the former managing director and CFO at MCE Social Capital. And we also have Stephanie Gripne, who's the founder and CEO of Impact Finance Center, which is an investor accelerator that activates impact investors. So I actually just want to really quickly, before we get into the fun, juicy parts of this conversation, starting with Stephanie, would just love for you to briefly share how it is that you got into the work that you're doing.
Oh, that's a great question. Thank you so much. This is a dream panel for me. I really believe these 3 financial products will save the world. And my origin story goes back to when I was a 15-year-old and a 19-year-old. When I was 15 years old, I worked for a river guide in Idaho. And I love river rafting. I love the river guide community. And when I was 19, I worked for a fisheries biologist in Idaho. And the fisheries biologist was writing the biological assessment, essentially the report that would determine when they were going to shut down the river so the river guides couldn't be on the river. And so my friends from when I was 15, they threatened the life of the fisheries biologist, and they made a bumper sticker that said, "Happiness is Jill Dufour's face on a milk carton." Happiness is Jill Dufour's face on a milk carton. So the people I loved were in pain, the river guides. They were in pain and fighting for their livelihoods, and they felt like it was them or the fish, the endangered fish. And I grew up in a ski resort in Idaho. So even though I had a single mom who was a dietitian for the school district, I lived in a place with abundant wealth. And I knew in my heart that there was plenty of money, and we were playing in this false game of scarcity. Instead of saying, wait a minute, there's plenty of wealth for the river guides and the fisheries biologists and the fish, the narrative that the river guides had was, I need to threaten the life of the fisheries biologists in order to save my own livelihood. Sound familiar? And so that moment, which I did not realize, that led me to get an undergraduate and master's degree in mathematical systems ecology and a PhD in forest economics, because it was always around the fish and the wolves. But after my PhD, I realized it wasn't about the natural resources. It was about the flows of capital into my community. And so what would happen if we start from the conversation of, we have abundant resources, even though none of us feel abundance, we feel scarcity in our private lives and our professional lives. What if there was plenty of resources, it's stuck like dams in a river? And what if we can reimagine and unstick those dams and let the capital flow so we can heal the river guides, the fisheries biologists, and the fish?
Beautiful. My name's Lizette Peña. I'm really honored to be here. I started with this work after about 15 years in public accounting as a CPA, working with organizations and companies that really only cared about profit and making a few rich. And I finally was lucky enough to work with an organization that was a worker-owned cooperative, and I was involved on their audit team and just shocked at how there was a possibility to do business differently, about doing the right thing, being responsible and paying for things that maybe weren't your responsibility, but it was the responsibility for someone to take care of the environment, meaning this organization took over a new lease that was on a gas station, and the prior owner didn't clean it up. And so when I was auditing that balance sheet, I was like, what are these liabilities? And they're like, we're gonna pay for this cleanup, and it has nothing to do with what we've done. So to me, that was the first time that I really realized there was actually business people that cared about more than just profit. And from then on, I've just enjoyed working with cooperatives and just really been a voice and just a voice for change. Thank you.
Hello, everybody. I'm Wendy Turman, and my origin story in impact really started out of grad school as a financial advisor to governments. So I worked in the municipal bond market, advising on financing strategies and basically building really big models on bond issuances, and really learned the fundamentals there. Moved into economic development, and again, was really in this playground. I was in the city of Philadelphia, born and bred, both of us. And, you know, had all of these different sources of money available to us to create jobs, to manage real estate, to have impact with the nonprofit community there. We had grants, we had HUD dollars, we had state dollars, and then we were a public-private partnership with the mayor and then the Chamber of Commerce. And so we really dug in on this, and I would say as I was developing programs, really started pushing the envelope of getting banks involved, getting the private sector more involved in some of the work we were doing with the nonprofit community. And then I would say I took my full dive into impact more recently on the nonprofit and private foundation side, but was the former CFO at MCE Social Capital, who I know is here. Who also, again, my expertise more in the loan guarantee side, but has a really innovative model that I think is catching fire, and really, I know Stephanie's thrilled about it, so.
I'm going to take my position as backup moderator and make sure Aniyia, you answer the question too.
What brings me into this work? I'm okay. I wasn't ready to ask myself that question. I would say that, I've done a lot of work in building communities. I grew up in a family business in Philadelphia. My family used to own a cosmetology school and hair salons, and so entrepreneurship was very much a part of my upbringing, and it really was there's lots of parts to that story. You know, I actually am a classically trained singer, but I wanted to have a job that had healthcare and benefits and a steady paycheck before I decided to become an entrepreneur on my own, and then threw all of that away. But when I came to San Francisco, maybe 13 years ago, my husband's a software engineer who got recruited to work at a company here. That was sort of when I decided to transition into working in tech and startups. I worked in tech and startups. I started a fashion tech hardware company in 2014. And that was my real, at first me drinking the Silicon Valley Kool-Aid until I actually was out here shaking my little pan down Sand Hill Road and realized that the experience that the CEO of the company I had worked for before was very different than the experience I was having as a Black woman who then got pregnant during my fundraising, and it just was and I was building a hardware company. I had all the strikes against me, but I learned a lot. I learned a lot about how capital moves in this industry. I learned about how that affects the outcomes we get from technology in this industry. I learned a lot about how there is a disproportionate amount of funding that goes to women, to people of color, and to certain kinds of work that's trying to happen here. And so that really led me on the journey to starting some other organizations, including Zebras Unite, which you can see I'm clearly repping my set with the stripes today, and also Black and Brown Founders, which helps Black and Latino folks start tech businesses. I helped to start the Black Innovation Alliance, which is a coalition of 170 entrepreneur support organizations that help Black folks with pathways into into the innovation economy. And then that brought me to the work at ON, where, as I mentioned, I get to work on building alternative tech ecosystems, which is obviously about representation, but it's also about these other pieces that are very much about what we do here in the industry and how we get the results that we get from the technology that we build.
I'm going to double down on my question as backup singer here and say, I think it's an interesting frame before we jump into the actual financial products. There's a lot of ways you can frame this conversation, and you've been a part of a seminal paper and framework in this space.
Yes.
And Zebras
Right.
Fix.
Right. When I talk about zebras, and I imagine some of you know.
Raise your hand. Have you heard of it?
Raise your hand if you've heard of Zebras Unite. Okay, a few. But actually, true story, the very, very, very origins of it began with two of my co-founders meeting here at SOCAP, circa 2016. But there was a blog post that we collectively wrote, myself, Astrid Schultz, who is also around, Mata Zepeda, Jennifer Brandel, called Zebras Fix What Unicorns Break. And it was effectively positioning a counterpoint to what Silicon Valley has given us with unicorn billion-dollar culture, to say that there are businesses here that maybe don't know what kind of growth trajectory they're going to end up having, or are not trying to be a rocket ship to the moon, but are very interested in creating profitable, important solutions, and that those are zebras, and zebras are real, and anyone can be a zebra if that is where their heart and mission decides to push them. And so it really resonated with many, many people globally. There's a very large community of folks who identify as zebras, and it very much overlaps with all of the themes of the things that we talk about here at SOCAP as well.
Fantastic. I think, and then I'll pass it right back to her on the last question is, close your eyes for a second. Close your eyes, take a deep breath in, hold it, breathe out. Keep your eyes closed. Think of your own money for a second, your own personal money. What if there was an easy button? Maybe you have a 401k and IRA. Maybe you have some money in a bond or a CD. Maybe you donate money. What if there was a magical easy button and all of those 3 buckets of money you have could invest in everybody in this room? And you could get the same financial return, the same risk, the same liquidity, except you'd get to go touch and feel what you were investing in. That's the promise of the 3 elegant financial products we're going to talk about today. And I'll say that because we activate investors, and there's 3 types of investors when we run an investor accelerator, and you can open your eyes. One of them is this man named Praful Shah. He has invested in 110 impact startups. Happy to connect you. He invests in Colorado. And he doesn't mind chasing down 110 K1s every tax season. Most people don't want to do that. There's another person named Ken Tsunoda. He's like, we're going to get 10 friends from college and form an LLC, invite our other friends, and we're going to chase down the K1s for everybody. So we'll have an LLC. We'll do it like a friends and family version. And then there's most of us. My best friend, Nicole. She gets activated. She invests in 5 beautiful souls that are in this room. And she's like, can somebody give me the easy button? I don't want to chase down those K1s. And so that's why we're here, is talking about how do we design the easy button for Nicole, who doesn't want to chase down those K1s. And I promise that will be my last backup moderation as I hand it over. K1, what's a K1? I'm going to pass it back to my moderator to explain that.
Wait, what? I'm literally on the panel with all the CFOs, and you're going to ask me the community builder to explain it. Go.
Yeah, so Schedule K1 is once you're an investor in an LLC or in a partnership, whatever little bit of income or loss trickles out to you personally comes in a Schedule K1, and it's generally a passive income, and you give that to your accountant to fill out your tax return. So if you have 15, 20 different investments, you're going to get 15 or so different K1s, and you have to work on whether or not those passive losses are deductible or not. So it can create quite a bit of confusion.
Okay, now I'm taking back over.
You do that.
We're gonna do a little game of volleyball here. Clearly, Stephanie's a wily one. Okay, so like this is the thing that I kind of like, because you kicked it off already. My first question was like, let's talk about this easy button. But I want to press you a little bit more, because I feel like, what is it that streamlines it? What is it that makes it easy? Can you like give us a sense of like what people should be looking for?
Absolutely. I had a different part of my life when I used to do transactions. And then I got recruited to be a professor at University of Colorado in 2010 to 12. And I was like, why isn't the money flowing? Why is it so difficult? And I apologize if anyone in this room is a registered investment advisor, but does anyone know how most investment advisors get paid? Anyone? Assets under management. Which means when my best friend goes to her guy at Merrill Lynch and says, I met this cool entrepreneur at SOCAP, I want to take money out of that portfolio and invest in that beautiful human I met at SOCAP, does the investment advisor at Merrill Lynch make money or lose money? They lose money. That's friction. Even if they made money, would they know how to do it? Is that what they do every day? No. Even if they made money and knew how to do it, would they face institutional friction? Yes. And so in order to create the easy button, the way to invest in all of you is this magic little tool called a CUSIP code. Has anyone heard of a CUSIP code?
One hand. One hand.
Yeah.
What'd you say? Publicly traded investments. It costs, I learned about 3 weeks ago, it costs $350,000 to create a CUSIP code. So we're going to talk about a community note here. And one that's doing really, really well that has a CUSIP code is Calvert Foundation has a $600 million community note with 20,000 investors in it. So they said, we're going to grow a community note, we're going to create a CUSIP code, pay $350,000, and now my Nicole can take that CUSIP code, go to Merrill Lynch, and go, Tony, please invest in this note. Now, is Tony going to make money or lose money when there's a CUSIP code? Tony's going to make money because it stays in assets under management. That's the trick. And most of the investors, institutional investors, they have so little staff on their team. You might be at the Colorado Health Foundation with $3.4 billion, but there's 2 staff allocating $3.4 billion. So they outsource it historically to Towers Watson. They have a new team. The emerging manager database starts at $500 million. The emerging manager database starts at $500 million. So what we have to do, if we want to fix the game from within, is we have to syndicate all of us up to bigger numbers at 100 million, 250 million, 500 million, and then we have to spend $350,000 on a CUSIP code so we can give it into institutional products so we don't face that friction. And what's gorgeous about what we're talking about, the easy button today, is most of these asset classes are pretty obscure to the everyday person. If you ask the everyday person, do you have a retirement account? Yes. What return are you trying to get? They don't know. But most of them are trying to get a 5 to 8% return. Maybe they have a CD. They're trying to get a 2 to 4% return. And most of them donate money. And so what we're trying to do now is take all of the goodness that's happening at SOCAP and say, how would we design it for most of us to take our 401k IRA money, our CD money, our ability to co-sign for each other, add a CUSIP code. That way when we go to our investment advisor and say, I want to invest in all this beautiful goodness, there'll be less friction.
Okay, so I'm going to try to summarize what I heard there. check my math on this, which is that there are, well, obviously with the endpoint, there are these kind of obscure asset classes, but they still have competitive returns, and you want to be able to allow people to use their retirement money, their CDs, to be able to invest in these things. And the sort of complicated layer here that we're trying to streamline is investing in these opportunities that are right in front of you, typically rely on an asset manager giving you access to it. The easy button is being able to get access to these things without disincentivizing the asset managers. When we have these QSIP codes, it doesn't change their assets under management so that they're also incentivized to be able to offer these to people. So we want to basically help popularize or move these into a more accessible way in which people can kind of engage with the way they do with their regular kind of mainstream investing, but with more specialized products.
That's well said. So
Okay.
Raise your hand in the room. If there was an easy button, would you invest your money in all of each other? Raise your hand.
We like it. All right, well, let's get into the products then. All right. So we got a few financial products that we want to explore today. One is investment co-ops. Two is community notes, and also private guarantee programs. So I think we should start with a brief explanation of each one. And since Kachuwa is an investment co-op, how about we start with Lizette?
Great, thank
Yes.
you. So investment cooperative, does anyone invest in investment cooperative right now, just out of curiosity? Okay, just a few hands, great. It's a relatively new product. We are one of the few investment cooperatives, and what that means is that there's it's an ownership where you buy one share costs $5,000. So we accept up to 35 unaccredited investors. So that means just regular people like us can invest in Kachuwa Impact Fund with $5,000, one share, $5,000. Now, if you have a lot more money and you would like to invest more, you're still only going to get one vote, so it's equal. That's the beauty of cooperatives, is one share, one vote for governance and board of directors perspective. So what we do at Kachuwa is we're all volunteers, so there's no GP or LP structure, there's no fees that are being paid out, and we have our portfolio 60% real estate and 40% either direct investment, equity investment, or debt investment. And that 60-40 setup really allows us to be exempt from the SEC Act of 1940 so that we can accept unaccredited investors and don't have a lot of we're not considered an investment company. So imagine kind of like a REIT and a mutual fund. And our real estate is all impact real estate, like owning a building where there's a nonprofit involved, there's real humans doing things. We're not buying and selling, we're holding for 7+ years. You can get your money out after 7 years if needed. And so it just really provides an opportunity for folks to invest in something other than Wall Street. And the folks at Kachuwa, we all do all the due diligence and we review the investments, and our investment dollars are generally from either $50,000 all the way up to $500,000.
So just to
kinda like
supplement
high level.
that, I would say, wouldn't it be cool if there was a self-directed IRA or 401k for Main Street that's trying to give you a 5 to 8% return, except it invests in real estate and businesses in your community? That's what Kachuwa is.
Yes, and I definitely want to also point out this other piece. So one share you buy in at $5K, and that one share equals one vote. I feel like the sort of neutralization of power is also really interesting, because I think whenever we kind of get into these instruments, obviously things tend to advantage the people that put the more money in. So thank you for that as well.
Thank you.
Yes.
And it can be expanded beyond 35 accredited investors eventually and be into crowdsourcing. So it's when you started off, you have 35, but there's plans to add more and more non-accredited investors.
Yeah, and I wanted to add, every year we're allowed, once a year we do a fundraise, but every year we're able to accept 35 non-accredited investors, so those will build upon themselves.
Making a note. Okay, let's get into community notes. I'm looking at you, Wendy.
Yes.
Yes. Can you tell us a little bit
notes.
about the community note?
Sure, and I think that's probably one of the more mainstream investments that we know about that is utilized, especially in that kind of education of philanthropy. And the next step is really I don't want to say concessionary, but community or catalytic note where you're able to actually lend money into a social enterprise, a nonprofit, an impact organization at maybe a 2% return. Typically try to provide patient type of capital. I know if you've been here for the last 3 days, you've heard about patient or, community ground up investments. So really meeting and enabling the organization that you're lending to have a little bit of more space and patience to repay that. Also better margins for that organization.
Got it. So lending money at a 2% rate to social enterprises, nonprofits, and also this is patient capital.
Yeah.
Wonderful.
And generally, I mean, it could be it's a fixed rate product. It could be a 0% note. It can be a PRI, an MRI. So these exist, I think, in a lot of impact portfolios right now.
Wonderful. Okay, and can you talk to me about how that also plays with the private guarantee programs?
Yes, I can. So the private guarantee, I think I've heard that a few times over the last few days, and that's a little more of a sophisticated product. It's a credit enhancement for the projects or for whatever organization that you're giving your guarantee to. There's a wide spectrum of guarantees, so you can have, like I said, when I started in economic development, we used the power of the government of the city of Philadelphia or our organization, which had about a $300 million balance sheet, to provide credit and backstop loans to nonprofits who were waiting for grants, reimbursable grants that they needed to upfront capital. These ranged from a community bank lending $10,000 for an arts organization to buy a curtain to $5 million for a museum, the National Museum of American Jewish History, which was doing a landmark capital campaign for a new building. So that's one kind of form that I think we're more familiar with, and so using kind of a large organization to backstop loans for smaller groups or folks with less.
Hey, Wendy, can we ask in the room, how many people have heard of a guarantee before? How many people who have not heard of a guarantee before?
All right, then apparently I'm going to speed this up because you all know what I'm talking about. So one of the other opportunities, I think, with guarantees that we've used is a pooled guarantee, where you are basically getting a group of guarantors together, raising funds. CIGP has one. They've raised about $40 million in guarantees, and then putting those either into projects or to backstop a loan portfolio in that way. I think they play really well with notes, community investment notes. So when I was at MCE, and they're still doing this, what we would kind of market really is a community note at 1% to 3% and a guarantee. And basically the interest off your community note will pretty much cover any liability that you would have off your guarantee with a well-managed portfolio or backstop. So.
May I quickly try to reframe that a little
Sure.
bit or so? So I think the bad part about a guarantees is most people like you have not heard of them. So I say it has a new tax. And so when I'm explaining a guarantee for somebody who's never heard of a guarantee, I say, have you ever thought about co-signing for your child's house? Your child's an adult, they can't buy a house without you co-signing. That's a guarantee. Are you willing to co-sign for your own Main Street or your own community? Your kids have left, they're gone. And what's cool about MC Social Capital is historically they aggregate capital. So I want to pull this apart from a fund of funds. This is not trying to make an 18% return on real estate. This is saying going after people who have 5 million or more. In Colorado where three of us live, there are 56,000 people with $5 million or more. They go and say, hey, You're not using this for 15 more years until retirement. Can you donate a $1 million one-year evergreen guarantee to this nonprofit that's going to aggregate capital for microfinance institutions that support women and girls? You have to give us 18 months until you pull it back. Last I heard from Wendy, it was like 146 $1 million evergreen guarantees. Go to the bank, you borrow against it. How much? $75 million at...
Yeah, so you can leverage it. So when we originally started, we leveraged down, so about 50% of the guarantees, so called 130. We had a 75 million portfolio. A better percentage is 1-to-1.
But you go lend out. So you have all these 100. It takes a half a day to fill out the guarantee. You donate it into the nonprofit. They have 140. Let's say we'll keep it simple. $150 million of $1 million evergreen guarantees. They go to the bank, they borrow $75 million, they lend it out to support microfinance institutions to support women and girls around the world. Maybe they default $150,000. They go back to each of the guarantors and go, we helped out this many women and girls, this much economic development. We defaulted $150,000. Would you do a $1,000 tax deductible donation this year to our nonprofit? And you have to give us 18 months notice until you yank your guarantee. How long do people stay in the program?
I think it's about an average of 7 to 9 years.
So imagine Colorado has 800,000 people with $1 million, 56,000 people with $5 million. California has 6.5 people with $1 million. Imagine if there was an easy button to say, would you like to co-sign for your community?
And I will tell you, I see a few MCE guarantors in the room.
Okay, so I want to try to combine some threads here. I'm like, you guys are getting me some work here. We're jumping around my order of questions, but because I feel like it's the really important thing here is it seems like clearly everyone in the room is familiar with the concept of the guarantee. What is special and what we're talking about here is the ability for individuals to do it instead of larger institutions. And I like the way that you position that, Stephanie, this ability to sort of co-sign on your community or on your main street. And also wanting to sort of add a little point of clarification in here. These are largely this combination of the kind of community note backed by the private guarantee are largely doing microfinance investments?
It doesn't have to be.
Okay.
That's what MCE Social Capital is doing.
I see.
The Community Investment Guarantee Pool, which is out of Locus Impact, they're doing it domestically. They're doing it for small businesses, affordable housing. So they are lending a credit guarantee to projects here domestically.
Got it. So a wide range of things that can be invested in. Yeah. Stephanie, I see you look like you're about to say something. Go ahead, girl.
When Wendy lives in Evergreen, Colorado, Lizette lives in Denver, Colorado, and I was sitting here, I was like, why the MCE is freaking brilliant and not enough people know who it is. Why don't we bring it domestic? If we can get that many people to co-sign for women and children in microfinance, can't we do the same thing for our own communities domestically in our own neighborhoods? And so just to give you a sense, we're working on a U.S. Forest Service workforce housing project. We're short $22 million. How many guarantors do you think we need at $1 million a year to close a $22 million housing gap? How many co-signers do we need? 5. If we can get 5 guarantors to co-sign on that project every year for 10 years, that reduces the debt coverage ratio and closes a $22 million housing gap. So what we're essentially saying is what MCE Capital is doing is gorgeous and beautiful, as well as Kachuwa Impact Fund. And imagine what would happen if you combined them and brought them domestic.
Okay, so now I want to try to let's try to bring this a little bit full circle. So we've talked about the investment co-ops, we've talked about the community notes, we talked about the private guarantees. We're now I want to translate this or try to sort of put this in the context of the easy button. So these would be the kinds of products that are kind of working behind the scenes that said easy button investor is going to go on their, I don't know, fidelity.com or call their guy and be like, that thing that Kachuwa is doing over there, that's where I want my money to go?
You got it. We kind of frame this as Main Street 2.0, the best of Wall Street comes to Main Street. We say 150 years ago, you were working at your family business. I was the grocery store person. You're like, business is going great. I need an extension on my credit. Can you give me some, trust me? And I said, oh, my family's known your family forever, of course. And that's used to be how we all invested. When we teach people about investing, we say, you don't have to learn to become an investor. You have to remember that you are an investor. You don't have to learn, you have to remember. And I would say 90% of that transaction was beautiful and good. You win, I win, we look each other in the eye, there's accountability, but there were some risk issues around like geographic risks and diversification risks and sector risk. So what did we do after the 1930s, after the stock market crash? We said, we can't invest in each other anymore. Mm-hmm. And you know what Wall Street's brilliant at is measuring and pricing risk. And so what happens if you take the best of Wall Street to measure and price risk, and we go back to the good old days with some deep work around racial inequality and say, let's invest in each other and look each other in the eye. But let's create aftermarket risk and liquidity product that assumes if you make less than $250,000, you get the same financial return you would have gotten in the S&P 500, the same risk, the same liquidity, except now we can invest in each other.
Okay, so I think I now want to sort of transition to talking a little bit about, since we're in the risk world now, I think let's talk about the challenges here. Like I imagine that there are some obstacles, hurdles, inertia to getting, like, for instance, you sort of named having 5 guarantors for this project that you would work on. Do you think it's like the first 5 people you go to and they're just like, hell yes, this makes all the sense to me? Like, what is the kind of like mind shifting, if any, that needs to happen? Like, how do we make sure that the soil is fertile for these to begin to really take root?
I'll take a stab at that, working with guarantees and having to work with lenders. And I would say in this workforce housing project that Steph and I were working on in Colorado, you know, a need is there. It was affordable housing in the mountains in a ski community. There's very little chance that those units are going to be empty. However, there's a lot of risk in that first 5 to 7 years of the project while they're building it and getting it motivated and inhabited. So I think what the issue was for us is working with, so that this was a bond-funded program, we were working with traditional financial group. I don't remember the underwriter's name.
It was Citigroup, but JP Morgan, and now we're in a third bond provider.
Okay. So it really was actually, I think, educating and expanding the minds of those who we were going to be working with. They understood, you know, I could speak their language. We've got the debt service coverage. We've got our capitalized interest accounts. How do we shake these loose a little bit? Can we put guarantees in place instead of your debt service coverage account? Why are we holding $6 million? Granted, we can invest it, but, you know, let's move some of these levers. Let's put some community notes in at $2 million. They liked that idea. That was cheap capital. That was exciting. But so I really think that there's just not a shared language, and they honestly really struggled to understand who and why we would do this. And so I think that was new to them. So I really just think it's the conversations and kind of making our way into some of these more traditional financing structures to try and break that open.
So what I'm hearing is when you're kind of engaging in these conversations, these opportunities, it's sort of coming into the frame in which they're used to understanding how these are going to be structured in a traditional structure, but you're kind of like doing a little bit of like I don't know why the phrase in my mind is like Mad Libs, how you like kind of like insert the thing here, but like instead of that, let's take that out. Instead, let's replace it with this. Instead of this one, let's like replace that with that. Yeah? Okay. And how does that, has that been a successful strategy?
I think there's a lot of interest in it. It's still a moving target. I don't even have the latest update. And the market did improve, so we weren't there. But we had guarantors and investors pretty much lined up and ready to go. Not the full, but
I'm happy to give you an update, Wendy. Yeah. So there's two parts to the issue. One is you need activated investors. And that sounds easy, right? That's not easy, that's hard. So in Colorado, we identified, educated, and activated as an investor accelerator 155 investors who are now investing in Colorado. So they exist in an existing database. So when the US Forest Service said, you need to help us out on this national priority project that randomly is in Colorado, we got to start not at the starting block, we got to start 10 miles ahead on a marathon, because we were starting with an existing activated database of impact investors. So one is you've got to do the hard long-term work to identify, educate, and activate what we call full spectrum capital investors, so they're ready to go. And Wendy and I have a dear friend, Doug Spencer. He is the guinea pig investor that's willing to go down the chute first. And so when we're working with a new bond provider, which we're on our third one right now, and it's going to work this time, we're like, listen, before we bring a brand new impact investor that's never done a single investment to the process, we have to create the underwriting process with the bond provider. So it's not undifferent like you buying a house and going through all those documents on a mortgage. And we have to create a new underwriting process. And Doug is like, I'll be the guinea pig. I'm already an MCE social capital investor. I will go through the hard work to develop the underwriting process with the bond provider. So I'd say it's 2 steps. You gotta have your activated investor database. You gotta identify, educate, and activate those investors. And then you need your guinea pig investor that's willing to go down the bobsled group to actually create the underwriting process with the Wall Street finance provider.
Got this. Okay, so then I hear the 2 parts there are making sure you've got the activated investors. It sounds like there's a long game to play there to build them up and have them at the ready. And then also this piece about underwriting the process. So is this something that you think translates or can easily be propagated outside of the state of Colorado?
Absolutely. Right now we're supporting 10 community foundations and health conversion foundations and place-based foundations around the country that want to raise their first 100 million. And so the long game magic dream here is we're actually in discussions with Kachuwa to say, what if Kachuwa Impact Fund and the function of MC Social Capital had a baby, and they were under one entity? And so we're in discussions about creating a subsidiary under Kachuwa that would have all 3 functions: a community note, a private guarantee, and an investment cooperative. So you'd have your self-directed IRA, your CD, your private guarantee, and that would be able to be, help me, white, black, brown labeled out to any community. So you'd be in Duluth Superior Community Foundation, and they would say, we'd like to roll out our Duluth Superior for investment cooperative, community note, and private guarantee program. And they wouldn't know this other group was behind the scenes, because from a retail perspective, it would be rolling out as the Duluth Superior local note guarantee and community note and investment cooperative.
Right, so one of the other opportunities here, in the spirit of easy buttons, is to have that kind of infrastructure already set up at a place like Kachuwa, and then allow other folks to be able to white label it for their projects and communities. Got it. Okay, so then I feel like we're already kind of going on this train, so let's follow this thought. And next steps, where do we see this going? I know that I've heard you also talk, Stephanie, about the ability to sort of scale with other kinds of government funding. I'd love for you to talk a little bit more about that.
Absolutely. Has anyone heard of the Department of Commerce EDA Build to Scale grant program? Anyone? We have 1, 2, 3. For the last 10 years, the federal government gives grant funding to grow ecosystems for tech entrepreneurs, $50 million a year. And it's only to grow angel and venture capital investors. So let's say 10 to 20 million of that 50 million every year is really investor accelerators to grow what I'd call extractive investors in this space. So what we're doing at the secretary's level of USDA and Department of Interior is saying you need private sector match for housing, businesses, and nonprofits, and your sibling agency is giving grant funding to grow angel and venture capital investor communities. Why don't you give grant funding to grow Main Street investor communities for housing, businesses, and nonprofits? And so, thank you. And so the idea is there's a 2-pager that we'll have ready in about 2 or 3 days, and we need everybody's help to get that 2-pager in the landing teams and transition teams of the administrations. And what's beautiful about this project is your sister agency is doing this gorgeous Build to Scale EDA program for tech entrepreneurs. We want to do a Build to Scale for Main Street in every agency that isn't Department of Commerce. So one, that would give communities money to set up their infrastructure, grow their Main Street investor communities. And let's face it, even the startups need 2% debt, 5 to 8% equity, and private guarantees.
I would certainly take that back in the days I was building tinsel.
And then the second piece of it is we need investor accelerators. We need 10,000 investor accelerators in the United States and another 50 per country outside the United States. So how do we do that work? We have to work with anchor institutions like universities, community foundations, associations of investor groups and foundations, and we have to create a white-labeled center or institute for financial innovation and impact investing. How do you fund that? Well, we're in conversations with multiple universities. NSF Core is a program that has taken Lean Startup out of Stanford, and they put gazillions of dollars to universities to say, create entrepreneurship programs for Lean Startup. And so we're going to be pitching a pilot program with NSF Core to do investor training. So we're like, that's great that you get the entrepreneurs ready for the capital, but you have to put the same gazillions of dollars in higher education, community foundations, associations of money to identify, educate, and activate investors in a non-conflicted way so that they can grow into become Main Street investors in their community. And once they're activated in that way, then they need the easy button.
All right, so I heard 2 things in there. One was this sort of in the flavor of the Build to Scale program, can we get government to match the money that people are putting in for this and growing Main Street instead of the typical startup application we have now? The other part of it is around the investor training through partnerships with universities, through CDFIs, other kinds of organizations that can reach people and help them kind of come along into this new way of making money. Yeah?
Absolutely.
Okay.
And it has to be a B2B play. Like every accelerator, incubator, entrepreneurship center, small business development center also needs to have a sibling investor accelerator.
All right. I feel like we're ready to get into some questions from the audience, and I feel like we have been going back and forth real rapid fire here, so I'm really curious to see what folks have written down. All right. Let's start here. So can governments, hold on, let me read this to myself first.
That's long.
I want to say this is wait, read this word.
Can governments
Task?
something less for the profits made?
Sorry, I'm like, oh my gosh. I'm going to come back to this question so I can try to read it while they're answering the next one. Okay. How many corporate treasury cash investors do you attract?
You'd be surprised. We just handshaked on a contract here to do $600 million in corporate treasury yesterday in the Mid-Atlantic for diverse communities, LGBT, people of color, women, and veterans. So if you would have told me our little nonprofit academic accelerator investor education group, our first B2B partnership would actually be with Trellis, formerly known as GreenBiz, I would have laughed at you. So we're taking the same full spectrum capital. And what do we mean by that? We frame that expenses are negative 100% financial returns. And that includes grants, HR, and that all investments in Treasury have impact. And so we've coached Walton Family Foundation to do a $500,000 negative 50% interest rate investment to a for-profit sustainable seafood company. that leveraged a $6 million investment, and then we framed that a negative 50% return investment out of your negative 100% financial return expense money is an above market rate return. And then we did a 1.25x return after profit for a Native-led documentary film company by a Native woman. So what we do is we shift power to the community steward, and we reverse engineer the capital flows. How does that work in corporate treasury? Olivia called us 3 years ago at United Healthcare. She said, I heard your program to attract and retain a diverse workforce. I said, it's simple. Let's refinance the diverse worker personal debt at negative 1% interest. Let's increase their wages to a thriving wage and get them into home ownership. And she says to me, I only have $15 million. And I said, are you friends with your buddies over in corporate treasury? And she's like, yeah, I am. I said, do you know how much money is in corporate treasury? And she's like, no. And I said, $21 billion. And at that point, it was 40 basis points they were getting on cash. I said, so we're going to walk on over to corporate treasury and go, where's the money going? And they're going to say, well, it's going to Bank of America, then it's going to Bank of China, I think, and then I don't know where it's going after that. And so we're going to introduce them to impact cash sweeping solutions like C-Note and Inclusive and impact deposits. And they're going to put their money overnight into local community and CDFI banks. And then we're going to say, for every $500 you bring back into United Healthcare, we're going to give you a 1.5x return from 40 basis points to 100 basis points, which is 1%. And we're going to take $500 of 1% money, blend it with $50 of expense money of Olivia's money, and that's going to give us $550 at -7. We're going to lend that out at -1. We're going to refinance the personal debt of the diverse workforce. We're going to do an income sharing agreement to increase wages to a thriving wage. We're going to do down payment assistance to get people into asset ownership if they want, and home ownership. And then before corporate social responsibility and corporate treasury pilot this transaction, we're going to walk on over to HR and go, if we increase retention by 1% next year, can we have half of that savings?
Anything to add? All right, I'm like,
It's hard to follow.
she's dropping mics over here. Okay, I realized what the word was I couldn't read on this card before. The question was, can governments tax less for the profits made on impact investments, and could that move more capital into the sector? And an example, if I invest in a climate ETF in my retirement fund, is government going to take less on my returns?
Wendy, do you want to tackle that? There's actually a case study in France. So France has passed a law to do this, that if you invest directly in communities and in an impact fund, you don't actually pay taxes. So we don't have that in the United States, in state and federal tax system, to my knowledge.
Can we add that to the easy button agenda?
I know. What'd you say?
Can we add that to the easy button agenda?
Absolutely, we can add that to the easy button agenda.
Well, I mean, I guess you do have Muni bonds, right? Like some of those are tax exempt from a state perspective.
Oh, interesting. So there's like something we could borrow from there.
Absolutely.
Okay. How can cash-based communities be engaged through the Investor Accelerator?
Well, so what we call an Investor Accelerator, I would say 2015, I was trying to get a community foundation to use a giving circle. Does anyone know what a giving circle is? I hate to say this, a bunch of white women donate $1,000 to $2,000 into a giving circle, not aware that there's all these amazing black sororities that have been doing this forever with bigger dollar amounts. So they donate into their giving circle at the community foundation, and then they give it away. And it's fun. They get to like learn about things, share with each other, and they have a bigger bucket to donate. And we're like, could we turn a giving circle into an impact investing giving circle? Instead of just giving the money away, we would do 9 classes. And we would help give experiential education where they would get to learn, go from I'm a donor to I'm an investor. And then we do a call for social ventures. We're on our 4th one right now with the Women's Foundation of Colorado, which has been inspired by these amazing giving circles in the Women's Foundation of Colorado. And I thought we'd created a new thing. And I saw my dear friend, Deidre, at United Way, and she looks at me, she's like, Stephanie, that's a Tonda. I'm like, what's a Tonda? She was like, it's an immigrant lending circle. You did not invent a new thing. And so I think What's super interesting is there's a lot to learn and listen from immigrants, people that have been unbankable because they've been banking each other. And so it's a little bit of like, how do you learn and listen and take the best of what's happening in that space and then combine it with the new interesting stuff we're doing today?
This is the right question to ask. All the white people, tell your white friends. All right, next question. What are the expected returns for these products? Are you underplaying the risk? I didn't write the questions, I'm just reading them.
What was the last part of the question?
Are we underplaying the risk? But the first part of it was, what are the expected returns?
So I can go first for Kachuwa Impact Fund. So Kachuwa means slow and tortoise, and so the investment, the return is a long-term investment. So we do not have extractive returns, but currently we're at about 5 to 6%. Sometimes it'll be less, sometimes it'll be more. What drives a higher return for Kachuwa Impact? It's like when we sell a building, or if something big happens that year, but otherwise, it's going to be pretty steady Eddie at about 5 to 6%. And then as far as risk, we have something that we've invented that we call the impact loss reserve. And so that helps us take a little bit more risk in certain investments, maybe in folks that maybe are unbankable, or new entrepreneurs that have never started a business before. We feel that we can apply our impact loss reserve against that, which is some of our investor members have said that they would put up their own capital to fund any future losses against certain investments. So in the time that I've been on the founding board since 2018, we've only had to use the impact loss reserve twice, actually. So, and it's been under $200,000. So yes, there's going to be some losses, but that's how we sort of mitigate some losses, and it allows us to take additional risks. So those losses will go to the investors that had said, we'll go ahead and take that extra risk so the other investors don't have to.
Yeah, and I would chime in on the note product and the guarantee. You know, I think, well, at MCE alone, we offered a 3, 5, 7-year note investment, interest rates anywhere from about 1.5% to 3.5% on that money. And generally, you would, kind of mark to market. Every year, we look around and see what other community organizations were doing. I know there's quite a few out there that are easy to benchmark, and so kind of keep up with what it would be in the Treasury, maybe a little bit more than that. And so, honestly, I think those are very readily available, and I don't think that's overstated at all. I would say on the risk piece with the guarantees is, they are there to provide credit enhancement, and so you can structure those in many different ways, but to protect the note investors or your portfolio, the project in general. But
raise your hand if you've ever bought insurance for your plane ticket or a concert ticket. That's a risk product. There are insurance companies that can create custom safety net product. So our pitch to the federal government and several state governments right now is your job should be putting up that risk capital that is going to deal with additional risk or liquidity for the capital stack that is non-accredited investors. If you make less than $250,000, we want to give you, put that risk product over these 3 products, so you have the same exact, if not better, risk than you would have on the S&P 500. The same, if not better, risk as a CD or bond. The same, if not better, risk of co-signing, and make it so that if you need liquidity, you can get same-day liquidity out if you make under a certain amount of money, and attribute that to the S&P 500 and those other financial products to basically say, if you're going to take the risk to take your money out of Wall Street and invest it in Main Street, we're going to give you the same, if not better, financial return, risk and liquidity.
And I would just one other point on the guarantee piece too on these products. At MCE we pulled $130 million, like I said, in loan guarantees to support a portfolio of about half that size. And we would estimate on average that there would be about a $10,000 call. That was less than about a 2% default rate, which is pretty standard actually in the markets. And that was about a $10,000 per person donation check that they would write every year. So I think the concept, the pooling, really kind of helps the risk sharing as well, which is a really important aspect of this product as well. So.
Great. Sorry, I wanted to just try to jot down some of the things that what you said, just to kind of come back to Lizette's comment about the co-op, that it's a long-term investment, more or less 5 to 6% returns, especially when there's a major event like a building being sold, such and so on. And also that there is an impact loss reserve. There's some members that are willing to take on a little bit of extra risk to try to help mitigate that for everyone else. And then is there, because I didn't hear this from you, is there also some kind of a buyback if it's kind of a long term, if someone's in there for some while, but they're like, speaking of liquidity?
Yeah, absolutely. So our bylaws allow for you to withdraw your money after 7 years, and you'll get 100% of whatever you put in. There's no market value on our stock. It's just the cost of what you actually put in. So you would get 100% of your money back. If you need to take the money out prior to those 7 years, you can contact the board members, and it's generally 85% of your money would come back, or if there's some sort of extenuating circumstance that, you know, is causing you to do that. So yes, you can get your money back, and it's not based on fair market value or anything like that. It's just whatever you put in is what you get out.
Got it. And then on the community note, there's a 3, 5, and a year. Sorry, 3, 5, and a 7-year option with returns somewhere between 1.5 to 3.5% interest.
Correct.
All right. Okay, I want to make sure I get this last question in because I just got the flag over there. Roughly how many products are there with the CUSIP codes in the U.S.? Is there a database for that?
Well, everything you would buy from your investment advisor when they would put money into a thing has a CUSIP code. So we'd have to go ask AI how many of those there are. A lot.
The answer is a lot. Okay, I think we should wrap it. So actually, let me ask one final thing, which is, because I feel like we went around the world in 60 minutes. So can you all just give me one thing, if there was one thing that you want this group to take away today, what would it be for how they could get started, something they should research? If they're interested in learning more, what's the one thing? I'm going to start with you, Wendy.
Ooh, all right. Well, I would say, first of all, to this group who was obviously very interested, is that these products are available. They're more accessible than you realize. These are not, just available to large foundations. And so what I would really say is go to the Impact Finance Center, help motivate investors, help educate them, get some formal training on these products to lead you to the right spot, you or your organization, because I think there's a lot of innovation out there, and having an educator in that realm would be incredibly helpful. So plug for the Impact Finance Center.
And I think as an unaccredited investor, there are opportunities for us to invest. Kachuwa is one of them, and I think there's Janine Fipro was on a panel yesterday, her own panel of her book, Activate Your Money. I just wanted to plug for that. Really explains a lot of other ways that you can invest through Wall Street, but with ESG funds and other funds that are doing some really good work.
We have our conference is coming up, Impact Days, November 12th and 13th in Denver, Colorado. It's a 2-day executive ed course, and we have 17 teams from around the U.S. coming with teams of 2 to 10 people to raise their first $100 million for their community. So form a team, come in 2 weeks, come next year. If you need a code, let me know. And we have put these 200 education modules up on our institute. I'm happy to give anybody at SOCAP a free code. If you want to learn it, learn it. And then when things are stuck, ask the capital steward, the individual or the organization, and like, why are they stuck? Because what I've learned in the last decade is we keep pitching people to invest as if they're major league, and they've been educated on how to do that, when in fact, most of them have never written a check and they're at T-ball. And so get excited about creating an investor accelerator in your community.